Okay, so I'll start the webinar. Okay.
Sorry, Josephine. I keep seeing. Okay, sorry. The signal has gone off. It's fine.
Okay, no worries, no worries. I'm here. Yeah, if there's anything. Okay.
It's we are live now. Good to start.
Not yet. Hang on, I'm connecting to Facebook.
Can you let me know?
Yeah, I'll let you know. I'll let you know in the chat box. Hang on.
How do I win that car?
Invest with CGS-CIMB Securities.
Gotcha.
I'll compare.
Trade your way to the top. Really. Okay, I'm going to mute myself.
Right. Hi, good evening, everyone. Thank you for joining us today at today's CIMB-driven webinar. Today's topic will be on the overview and deep dive into retail REITs with very unique assets. Now, this webinar is hosted in partnership with SGX and VITAS. My name is Candance. I'm a research analyst at SGX, and I'm honored to be the host and moderator for today's session. Before we begin, a quick look at the disclaimers applicable to all CGS-CIMB webinars. We'll just take a moment to pause here. Now comes the exciting portion. For those of you who are new to the Driven campaign, this is a 6-month-long campaign open to all new customers and existing account holders of CGS-CIMB Securities Singapore. Now, to learn more, we'll just take a few minutes to watch a short video.
Think you're driven enough to succeed? Win a brand new Tesla Model 3 in just 3 easy steps. Open a CGS-CIMB trading account and start trading your way to awesome prizes. Participants can trade any of our 6 products to earn tickets. The more you trade, the better your chances. Earn as many tickets as possible from July to December to win the latest and greatest from Apple and be eligible for our grand prize, a Tesla Model 3. What's more, we've also lined up a series of webinars throughout the campaign period to help you become a savvier investor. Don't miss out on these free sessions. Register and level up your trading play. Open a CGS-CIMB account and start trading today. Think you're driven.
Right. So if you have not registered for the campaign, do scan this QR code to register yourself for the Driven campaign. So start participating in the campaign and you can stand a chance to win a Tesla Model 3. Exciting, huh? So you'll be able to learn more about the terms and conditions as well via the link. So you can take a minute to scan the QR code and we'll come back to the webinar in a while. Right. So now we'll start the webinar proper, just an overview of what we'll be discussing today, a few key latest trends on the performance of Singapore REIT sector, as well as a deeper dive into Sasseur REIT and United Hampshire US REITs, which have very unique assets within the retail REIT space. And we are very honored to have with us today 3 guest speakers, the regional property analyst Man Yi from CGS-CIMB Securities Singapore. Now she has more than 15 years of experience in analyzing the Singapore property sector. We're also very honored to have Cecilia, CEO of Sasseur REIT. Now, Cecilia is also very experienced. She has more than 20 years of deep real estate experience across a range of expertise. And last but not least, we have Robert, CEO of United Hampshire US REIT. He also very experienced CEO. He has around 30 years of experience in the real estate industry. So we'll welcome all these guest speakers today. Very honored to have them. And before we talk further, we'll start off the session with a presentation by Man-Yi on the overview of Singapore REIT sector, and followed by a panel discussion with all three guest speakers on some of the key trends we're seeing in the industry. So if you have any questions for the speakers, do type them into the Q&A section of the webinar, and we'll try our best to answer them at the end of the webinar. Now, I'll give the floor now to Man-Yi. Man-Yi, would you want to try sharing your screen, and I can pause and stop mine.
Okay, thank you, Candace. Yes, let me share screen.
Sure.
Okay, can you see it?
Yes, good.
Okay, great. Okay, shall I start?
Yeah, yes, please.
Okay,
Thank you.
thank you everyone for taking time to be with us today. Today, we'll be just sharing a little bit on the S-REIT sector and also our outlook on that sector. You probably hear a lot about the macro news flow, about interest rates, about inflation. So we thought that it would be quite timely just to share some of our thoughts on this sector. Going to the first page. Okay, so this is just a chart on the performance of the FST REIT index versus the STI. And you can see that so far year to date, the REIT sector has actually delivered a total return of about 3.6%. It's slightly below that of the STI index, the broader market, but it is still a positive return. Okay. In the next page, we break down the performance of the REITs by subsector. So we have retail, office, industrial, hospitality, healthcare, diversified, which is a combination of office and retail broadly. And we can see that healthcare actually outperformed quite a bit this year with a total return relative to the STI of about 25%, and just an absolute return of just under 20%. And I think this is also partly one of the reasons is you find that some of the healthcare REITs did announce some rental renewals as well. The second outperforming subsegment is the industrial, clocking in about 15% relative absolute relative return to the STI, while sectors like retail delivered a 7.5% relative return. Hospitality is the only one that's still clocking in a negative return year to date. But given where the expectation are opening of borders, I believe this sector could also look interesting. This is a breakdown by a stock. Again, you can see that the best performer this year has been ARA Logos Logistics Trust, and followed by selected of the retail REITs such as Star Hill Global, as well as Savannah Sharia compliant industrial REIT. Okay, so this is a chart on the valuations of the S-REIT. Currently, the S-REIT dividend yield is roughly about 4.3%. The sector has come up in terms of prices, so the yield has actually gone back up slightly compared to the recent low that we saw earlier, mid of this year. In terms of the price to book, let me just shift this away. In terms of the price to book, we are at about 1.1 times, again, off the high that we have seen recently. This is a chart on the forward dividend yield by subsector of the S-REITs. Essentially, the office segment, which includes the office, the overseas office REITs as well, is projected to deliver about 7.5%, followed by about 6+% by industrial, and retail is projected to deliver about 5.5% on the overall. Okay, there's been a lot of talk about, you know, what expectation of rising interest rates. So we thought that let's take a look at the balance sheet of the REITs and where they stand and how robust they are. So essentially, if we look at in terms of just the debt maturity profile for the pie chart on the left, S-REITs, have a relatively well spread debt maturity profile, with only 13% of total debt being or due to be refinanced in 2022. And there's a balance of 5% for the second half of this year. So very little refinancing risk that we see in the short term. In terms of what could rising interest rates impact in terms of earnings, we see that 76% of the REIT debt is actually in fixed rates. So this will enable them to hedge their interest costs in the near term. So they are quite well positioned in this part of the interest rate cycle. This is a chart of the debt to asset ratio of S-REITs. On average, the S-REIT sector has a debt to asset ratio of about 39% compared to a ceiling of 50% under the S-REIT guidelines. So quite well managed in terms of where they are levered at this point in time. Okay. We just wanted to share a bit on the S-REIT growth outlook. I think essentially what we are seeing is that S-REITs, based on our coverage, is expected to deliver a 5.4% DPU growth for 2022 on top of a 12.1% DPU growth for 2021. So what this means is that if the long bond yields continue to increase, this DPU growth or the growth in the projected yield of the REITs would mean that the yield spread of the REITs would be maintained, with this 5.4%, assuming that interest rates do not, assuming one interest rate hike of about 25 bips going into 2022. But nonetheless, what we have seen is that historically, if you look at during periods of the Fed taper, rising inflation and rising 10-year bond yields, it could mean that near-term share price could be a little bit choppy, but we think that the choppiness or the weakness could be an opportune time to get into the sector. And the following chart will basically share with you why we think that is an opportune time. Okay. This is a chart that shows the performance of the REIT index versus inflation and the bond yields. The green line is the CPI. The dark blue line is the 3-month SIBOR. The light blue line is the REIT index, and the dark red line is the 3-month 10-year yield spread. It looks like a lot is going on in this chart, but basically there are 3 key takeaways. I think we often get asked nowadays, what would the effect of inflation have on the REIT sector? So we can see for example, during the 2016 period, where we see this long run in the Singapore CPI index, what we do see is also that the REIT index at that time continued to be on an uptrend. And I guess it brings us back to the saying that real estate is a hedge for inflation. So it actually points true. Okay, that's the first takeaway. The second takeaway is that what happens in the previous periods where you see interest rate rising? Let's take a look at 2 periods. Basically, in 2013, that was when the Fed signaled that they would likely hike rates, and also during 2016, when the rates actually went up on a sustained basis. So let's take a look at the 2013 period. You can see that at the turn of the rate, there's a slight blip here. At the turn of the rate, the REITs tend to bottom out. It took maybe a quarter or 2 before the sector stabilized, but thereafter, you can see that the light blue line, the REIT index, continued on its uptrend. Likewise, if you look at in the 2016 period, we started to see rates being hiked again, interest rate going up and this time is on a more sustained basis from 2016 to 2019. And after the first turn of the interest rates, the REIT sector took probably a quarter or two to stabilize, and thereafter you can see this run up in the REIT index as well. So it performed quite well. The third takeaway from this chart is basically the expectation of inflation into the 10-year government bond yields. The 10-year government bond yields has continued to go up in the recent months, and especially after the recent FOMC meeting, we see that there is actually a spike in the 10-year Singapore government bond yield. So how do we read that? So what we saw that, again, back to the 2013 and the 2016 period, once the 10-year government bond yields have peaked and your short-term interest rate rises because you do see a more sustained economic recovery, that means that as your short-term rates increase, your yield spreads narrow, and this narrowing basically also indicates quite a high negative correlation with the REIT index. The narrower the spread between the 3-month and the 10-year bond yields, the market actually bottom out and continued to rise. So like you see a similar trend here as well. It peaked in 2016, and thereafter the bond yields continued to compress, and you can see this this rise in the REIT index. So I guess the next question is, do we think that the same thing will happen? To be fair, the signaling by the Feds is that they expect a first rate hike in the fourth quarter of 2022, and inflation is looks like it's going to be elevated in the short term. So I think during this period, we think that the REIT index could remain a little bit choppy, but then again, as we saw in previous cycles, once the rates, the 10-year bond yields and the interest rate cycle turns, then essentially we are positioned to see the index performing quite well. Okay. So the next chart is basically just looking at the US REITs versus the 10-year treasuries and also the 3 months Fed fund rates. Again, similarly, the trend has been quite similar. At the turn of the interest rate cycle, it took a while to get stabilized, but even after the rates continued to rise, you can see that the REIT index, the US REIT index, continued to perform quite well. So we think that essentially weakness in the REIT market is probably an opportune time to look at, or we look at the sector. Okay, this is my last slide. So I just want to conclude by saying that we advocate accumulating selectively into the market weakness for the S-REITs. As a subsector, we like the retail, we like selective industrial subsectors. Our current picks are basically A-REIT and SPH REIT. And but I think again, just to reiterate, looking at opportune entry points into the market weakness. So with this, I'll pass the time back to Candance. Candance, over to you.
Thank you, Mani. It's a very nice and insightful overview. I'm sure we can discuss a bit more on what you touched on previously, Fed rates, how that affect some of our REIT sectors, individual REITs over here. Would you, all right, okay, so you've stopped sharing. I think before we proceed to the next section, which is a panel discussion, let's welcome Cecilia and Robert once again. Very honored to have them together with us today, especially Robert, you're joining all the way from the United States. It's at 7 a.m. over there. It's really early for you. So thanks so much for joining us. Yeah, so before we begin, maybe we would love to hear a little bit more about, just introduction of Sasseur REIT and United Hampshire. Maybe I can invite Cecilia, ladies first. to give a brief introduction, just a brief introduction of Sasseur. Let us learn a bit more. Yeah.
Sure. Thanks, Candice, and thank you for organizing this and inviting us to attend. And today is also a very happy occasion for us because I just came off a CIAS award. So we won an award. I will not tell you what award, so watch for the news tomorrow. Yes. Yeah. I mean, Sasseur is actually, we are still a very young REIT. We have just crossed our 3.5 years of anniversary. We were first listed on the stock exchange on 28th of March 2018. We are the first outlet mall REIT, and of course right now our outlets are all in China. We own 4 outlet malls, one in Chongqing, one in Bishan. Bishan is part of Chongqing, and one in Hefei, and one in Kunming. So I think the outlet mall industry, perhaps I think most of us will associate with when you go to Japan or USA, you see that kind of outlet mall. But I don't know how to explain to you, but I think if you can think of maybe Vivo City, that kind of big scale, we are very much like a Vivo City, just that, in terms of positioning, we are outlet mall. I think I would encourage all of you to go to our website, where we have some very, really nice pictures. Recently, we have done a very successful September anniversary. So you can go and take a look at the videos. I think the pictures tells 1,000 words. So I would say that, we offer the investors a very unique class in China. And also later I will also touch on some points on money share. Indeed, I feel that this is, given the current REIT witness, is an opportunity time, especially for investors who are looking for sustainable long-term yield. You should also look at Sasseur REIT as well. Thank you.
Thanks, Cecilia. Thanks. Robert?
Thanks, Candice, for having me on as well. And I guess I'll start off by saying if Sasseur is young, the Hampshire United REIT is an infant. We launched our IPO March of last year. On March 12th, ironically, the day before the pandemic was rang in the United States and declared an emergency. So our timing could not have been any better. But we own a different retail product than Cecilia's company. We are basically necessity-based, grocery anchored, home improvement, essential tenants in open air, suburban oriented shopping centers. We are in the Eastern Seaboard strategically, because that's where a large percentage of the US consumer is located. These are open air shopping centers with large car parks, not as flashy as Cecilia's stuff, but a format that sells everyday goods and services that the US consumer needs to survive on a daily basis. As I mentioned, grocery, pet supplies, gasoline, drugstores, things like that. Necessity-based, very resilient as well because of their long-term leases and their necessity-based uses. So as I said, proud to be on the Singapore Stock Exchange, proud to be Singapore's, Asia's first grocery anchored and self-storage REIT. I should also mention that real quickly, do have some self-storage investments as well, which have a lot of retail qualities as well. But proud to be Asia's first grocery anchored REIT. And thanks for having us on, and we'll get into a little more detail going forward.
Thank you. Thank you, Robert. I think I remember last year during the pandemic, it was the IPO, right? It was like, oh, finally a good news among all the cases is rising and all the, the panic over there. But, yeah, we always welcome, as an exchange, we always welcome, Sasseur and United Hampshire. So, yeah, I think thanks for the introduction. Maybe we drill down a little bit more so that the audience can understand a bit more about the unique assets that you have. Because if you look at it, outlet malls, grocery anchored, strip malls especially, it's not commonly seen, especially in Singapore. So wanted to have an understanding what is so why are they so unique, and how is it different from the traditional shopping malls that we see everywhere in Singapore and the region? Yeah, Cecilia, would you like to go first?
Yeah, okay, thanks, Candice. I think Sasseur outlet malls, actually we offer some very fundamental and very unique qualities, very much unlike a conventional mall. Although, structurally and physically, actually, if you go to our outlet mall, it actually doesn't quite look like the conventional outlet mall that I mentioned earlier that you see in US or Japan. We actually sort of very large scale shopping center. And very much we positioning like a lifestyle as well, even though, the positioning is actually we sell many multiple brands, international brands and local brands at significant discounts. I mean, the value proposition is to offer some of this branded goods as well at affordable prices, giving value proposition to all the consumers. I think the other thing that which is also very unique to us, we feel that this is a very sunrise industry. Of course, a lot of people has been talking about how e-commerce has been a threat to, traditional shopping centers. Actually, we find that actually our business model has become proven to be very resilient. I mean, take for example, in the year 2020 pandemic, I mean, which Robert talked about when he listed at such a, I would say, historical time, it must have been in the minds of everyone, and we see how, the whole world due to the pandemic, particularly retail malls, right, suffer greatly. And a lot of the retail REITs here actually have to really retain cash and give financial support to their tenants. Actually, for us, actually the reverse. I mean, yes, 2020 was very challenging, but I think the business model, which later I'll share a little bit, the way we run this retail outlet actually proven to be very resilient. We actually rise above the challenge. For 2020, our DPU was even higher than 2019. Yeah, so I think this goes to the strength and the property fundamentals that we have. First of all, I think is also the EMA model that we have. Unlike most traditional malls where they will charge the tenant a fixed rent, actually most of the tenants in the underlying tenants in our outlet malls, they actually based on turnover rent. Now, of course, this business model cuts both ways. Yeah, when the tenants perform very well, the REITs get to enjoy the upside with them. But likewise, when the tenants are not doing so great, we will also, our sales will, our income will also be affected. But the EMA model actually is the best of both worlds, which is why even in times like COVID, the EMA model remains very resilient to provide a safety net for us. So the EMA model, is a very complicated model, but I wouldn't explain time here. But essentially we have a fixed component and a variable component. So the fixed component is to basically represent a bit of the fixed rent that a general tenant will pay, and then the variable component is actually what the underlying tenants eventually generate in terms of sales. So you can see this give you the protection of a basic rent, plus also the upside that goes with higher sales. So in 2020, even despite the pandemic, when we reopened our malls after closure about 7 weeks, it was a huge turnover rent that we collected because there was a lot of revenge spending, right, in China. So and also because this EMA model is very resilient, we also provide an organic growth of 3% year on year. So to the point that Mani mentioned about real estate being inflation adjusted, our EMA model actually caters for that as well. Yeah, the other thing I should also mention is, we have also received comments that our WALE, which is our average lease expiry, is typically quite short compared to a lot of traditional malls here. Traditional malls here, they will sign maybe 3 to 5 years fixed. We actually prefer to have shorter WALE because of the fact that we actually, you can consider us as a fast-moving consumer goods kind of industry as well. Because we have to bring a lot of brands and make sure that brands continue to stay relevant and attractive to consumers. So the flip side, if the tenants' leases are too long, it becomes difficult for us to change the tenant mix and reposition the mall to bring in other brands. So it was deliberately kept short so that our leasing activities become very active to continue to bring brands that will appeal to the consumers. Yes, thank you.
Thanks, Cecilia. I think it's interesting to hear you explain the business model a bit more, because I think, intuitively retail malls, even outlet malls during the downturn, usually you expect lower DPU, lower sales, but it sounds like pretty resilient, yeah, especially during this period. And I think same goes for Robert, right? United Hampshire is also grocery anchored, so that's very consumer staples. Could you explain a little bit more on how is the grocery anchored kind of malls and self-storage different from traditional malls that we see? And is it really more resilient, especially during this period?
Yeah, absolutely. I mean, when you look at the difference between malls and grocery anchored, what we call open air centers, completely different business model. Even going into the pandemic, as we all know, the traditional vertical oriented regional mall in the US were struggling. The advent of commerce, as Cecilia mentioned, people with Amazon, with the growth in e-commerce, people ordering apparel over the internet, malls were kind of on the decline anyway going into the pandemic. Occupancies were down. When the pandemic hit, it kind of exacerbated some of the structural problems within the mall industry. There were some bankruptcies, such as Sears, JCPenney's, Neiman Marcus's. And in the pandemic, the malls were actually forced to shut down early on even. So collections and occupancy dipped dramatically versus the open air shopping center. And I should say, we're using the word unique to describe our asset class. It is not exactly the appropriate term to describe open air grocery anchored centers, because if you look at the total retail space in the US, there's only about 1,000 malls left of traditional vertical regional malls versus the open air shopping centers. I don't even know what the number is, but it encompasses about 30% of the total retail space in the US. So there's a lot more of these shopping centers. They're located in much more convenient places near the neighborhoods where people live, work, and play, especially now with the new flex work at home business models that these businesses are offering. But they're much more convenient. They have large car parks where the consumer can drive up to the store where they're looking to buy their goods or services, walk in, get their product and leave, versus the large internal malls where you've got a massive conglomerate of stores. You've got several floors. You can't go in and out as easily. So there's always been this convenient component of the open air grocery anchored center. Combine that with Candance, you used the word staples. That's exactly right. Necessity goods, staples, products and services, groceries I mentioned earlier, but other things like liquor stores, barbershops, nail salons, to get day-to-day personal services. That needs to be a convenient format. And that's where kind of the value add of our sector is. It's got to be convenient. It's got to be able to offer tenants that can get the products and services to the consumer in various different ways. We call that omni-channeling. As the COVID kicked in, the evolution of curbside pickup accelerated dramatically. So people didn't have to get out of their cars. There was more delivery. So these open air centers are very flexible. They're very convenient. And they offer, again, a wide array of necessity goods and services that the consumer needs on a daily basis. So that's really kind of the value add for our sector.
Thanks, Robert. I think the word unique. I think for consumers, especially in Singapore, maybe not Malaysia or the region, but for Singapore, open air malls definitely is pretty unique and a rare sight in Singapore. All our malls are huge vertical shopping centers that you see. I mean, we do have a space constraint over here.
Right.
Yeah, but interesting to hear the uniqueness of United Hampshire. And I think we've mentioned a lot of COVID changes. How has that affected, the consumer behaviors and all the lockdowns and all the pandemic that has caused. But I think before we circle back to understanding a bit more of how that has evolved, especially it's been close to 2 years since the pandemic. Wanted to get a color of underground color of what's happening, especially in US, in China. But I think before we move on to that, I think maybe it's time to hear from Man-Yi, from perhaps the sell side on the investor's perspective, right? COVID has changed not just consumer behavior, but also investor behavior. I mean, before the pandemic, investors' priorities are in DPUs. They look at which REITs have the highest dividend yields. These are some of the key factors that they consider. But with the lockdown and with the pandemic last year, a lot of the REITs have retained earnings, to kind of conserve cash, conserve liquidity. Do you think that with that, has investors' priorities or key considerations changed? Do they still look at DPU as a key factor, or do they have other considerations now, like long-term M&A growth, macro outlook, or even a hot topic now, ESG? Are these other considerations also surfacing, in investors' minds?
Well, Candance, interesting question. I think yield will still remain an important investment consideration, particularly when you invest in REITs. But I think what we have seen is like during the period of GFC, we think that balance sheet strength is also very important. The ability to meet financing needs. And I think thirdly, as an investment, I think investors will also want to see growth, right? Especially if you invest into a sustainable long-term growth. So the capacity to sustain and grow dividends, whether from organic growth or acquisitions, is also relevant. So I would see that it is a total package. Yield has been, I think will continue to be, but the other factors are also equally important as an investment consideration.
I see. And I think we'll touch a bit more on your, like you mentioned, organic growth, balance sheet strength. We'll touch a little bit more on that down in the next few questions that we have prepared. And I think if we can circle back to the on the REITs perspective, right? COVID pandemic, so like I mentioned, it has been a year plus 2 years to the start of the pandemic. Things have changed. Countries are opening up. Even Singapore, we've announced some openings. We have a target of 3 to 6 months. A lot of green lanes to other countries. So wanted to have an understanding, some on the ground color of what is happening in the US, in China, what is happening. What do you see? How is the footfall, the tenant sales in your respective malls? Yeah. Maybe this time around we start with Robert here, the US side of the story.
Sure, Candance, that's a great question. The short answer is the footfall at our properties has really been on the upswing through the second quarter. At the peak of the pandemic on the open air shopping centers, on average, the drop off in foot traffic was somewhere around 30% pre-COVID. Compare that to the vertical malls we were talking about earlier. There's about a 90 to 95% drop off. And again, a lot of that was because of the required shutdowns in the malls, who couldn't provide the safety of the separation required by the COVID guidelines. But since that time, early spring, when we kind of probably raised the victory flag too soon on COVID, there was pent up demand. People have been bottled up in their houses for over a year, and people were getting out again. There was more mobility, and the footfall at our shopping centers evidenced that. As of June, the footfall in the open air centers was actually up at a level before higher than it was pre-pandemic. And now with the Delta variant causing some problems, we're still trying to get around the corner with the vaccinations, but people are still out there. People are still, for the most part, when they go inside, a lot of people are wearing masks, but it's very regional. But we're also seeing the consumer in a very good situation. The consumer has not been traveling, not been spending a lot on luxury goods, and therefore they're out and they're also spending a lot. Grocery sales are up pre-pandemic by about 4%. Apparel is also up. E-commerce, we talked about, accelerated dramatically during the pandemic. That actually tapered down a little bit. The numbers are all over the place, but it appears as if the e-commerce since the second quarter was dropped about by 3% from the peak pandemic. So people are out there shopping physically, buying their services, buying home supplies, buying groceries, even buying apparel. apparel clothes are significant in our off-price offerings. They're not just buying on the internet now as well. So things are changing. And again, I'll throw a caveat to this. Delta variant threw a wrench in things. I know travel and leisure services have started to trend back up dramatically, but I know, again, with the Delta variant, all of a sudden that cooled off a little bit. So we need to be careful about that, but people have been back out to gymnasiums as well. Restaurant usage was on the rise, but for the most part, formal sit-down dining has again tapered off slightly because of Delta variant. People are still doing the quick service restaurant and the pick up and take it home. But the consumer is healthy. The savings rate for the average household are better now than it was pre-pandemic. Despite a setback, as I said, in consumer confidence because of the Delta variant, the consumer spending money and retail is actually very healthy right now in our open air centers.
I think I can relate to that, especially can't travel now. My credit card bills have, multiple pages now. Used to have one page now, yes. Many pages now. And I think some of these you've described in the US, actually, I think it applies to Singapore and of course, as well in China, right? The rise in consumerism because of more savings and all, and especially the Delta variant, right? That changed things a little recently, especially in China. There's a few lockdowns, especially. And I think something that we are all focusing and watching closely now is the Evergrande saga and how that has put some focus into the real estate market in China. So Cecilia, can we trouble you to shed some light into this situation in China? How is that affecting the sales, the business of the REIT assets over there?
Yeah, Candance, I think maybe I will break your question into two parts. Let me address sort of the impact of the Delta COVID situation in our malls. I think, when China was the first to hit, I think, everybody was scrambling and trying to understand what was really happening. But, I think having gone 2 years, I think there was a lot of learning curve, both at the national level and also, at the sort of individual lives and also at the business level. So at the business level, we have also during that time clearly understood sort of where operationally we need to sort of be strengthened. I think I'm very proud to say that during that whole episode, none of the workers, none of the tenants got infected. So you can see that our group, Sasseur Group in China, they are very careful about this. Okay, the other thing is, of course, no one is immune. Even though China, they take a very hard approach, they're still having this zero tolerance strategy. I don't know how long they're going to hold on to that. But I think at the end of it, people are also trying to get back to normal life. So you can see that actually that bears out in the sales in the DPU that we have also generated for first half is still very healthy level. We're still year-on-year performance growth compared to last year. So people in China are getting back to normal life. But yes, I think we saw some isolated cases starting in July and August. And the China approach is that they don't do a whole city lockdown. They try to sort of do an isolated basis. So I'm glad to report none of our malls were affected. So we didn't have to do any close down. So basically life goes on as normal. But I think what is also apparent because of all this volatility causing due to the COVID pandemic, we have also accelerated our digitalization strategy during this period. So, rather than for e-commerce to become a threat, we actually use it as an opportunity to complement and supplement our whole retail strategy. So we have gone into very specific, say, collaboration with certain brands like Adidas and Coach. We have run some very successful, live programs where, flash sales. So, China is actually quite ahead in terms of technology, in terms of digitalization. So, we are very glad that we have a lot of these ample tools available in China that, our sort of marketing team can avail themselves to. So we use a WeChat channel, all the Omni channel. So, it's full power on, right? So even when people are feeling a bit fearful, not because they don't want to spend, but how it is with sentiments, right? But they still have an urge to spend, so these channels will become very readily available for them, that they don't miss out any sort of good deals in the mall. Right. So I think this pandemic, I think what cannot break you will make you stronger. I feel that's what our group is experiencing. So, we're going to go from strength to strength in terms of trying to overcome all these external forces. So Evergrande is again one of them, right? So you can see this past 3 weeks, the whole Hong Kong market and even Singapore market, especially the China stocks, they face a lot of selling pressure, even things that nothing to do with us. I mean, we have no dealings at all with Evergrande, but I think it's just, very sentiment driven, a lot of concerns at the regulatory level. How is that? And of course, I think if you speak to people in China, they actually don't think this Evergrande is such a big deal, because actually, the impact is not as great as what is being reported here, right? But we need to understand that China is a really big country. So I would like to say that, for us, we are going to take this in our stride. We continue to focus on doing what we do best. There's a drive revenue through our business model, which is why our September sales went off with a big bang. So our September sales, we have 24 hours, whole day sales at 2 a.m., 3 a.m., 5 a.m., 4 a.m. We have people, thousands of people, hundreds of people still in our malls. We got traffic jams. We have to call the police in to manage traffic. So you can see that people's desire to go out there, leading a normal life is great. The desire continues to be strong. So we hope we continue to be able to satisfy their needs to buy branded and discount goods at value prices.
I'm sure. And next month is 11/11, right? 10 just passed. I'm sure it's going to be another, a big month for all the malls. But interesting to hear the Evergrande side and China, what is happening over there. And I think COVID is just one of the topics that has changed lives and that the investors are focused on. So there's a few trends over here in the REITs market, especially in Singapore REITs market, that we are seeing. I think one of them is asset acquisitions. So actually, if for those of you who have been following, I think Singapore listed REITs have acquired assets of, I think, purchase acquisitions of close to $8 billion for until the 10th, I think until last month, I think close to $8 billion. So it's a huge amount, I think a record-breaking amount as well. So I mean, this is a long acquisition spree, right? So I'm wondering, Mani, do you think, as a from an analyst perspective, do you think this trend will continue? Do you know why sudden a huge increase in acquisitions over here in the REITs market?
Hi, Candance. I think the REITs have been quite active in acquisitions this year. We think the trend will continue. I think the interesting thing is that what we are seeing, like apart from real estate being a hedge to inflation, when they purchase an asset, the considerations that they go through, things like location is important, quality is important, the property cycle, pricing, even factors like underlying tenants, I think are important factors to determine the quality of the property that you're acquiring. I think apart from that, like you mentioned just now, is ESG going to be important? We think so. We think that buyers of properties could essentially look more into this aspect, because it is a way of trying to future-proof your portfolio, right? As you go forward. So I think all these are important factors, and I think the REITs will continue to acquire. So that's what I think is likely to happen.
I see. I think in terms of, I think you mentioned some, right? ESG, location, all this. From an investor perspective, what would be key consideration or factors to look out for when you are analyzing a REIT you're investing in, their acquisition? DPU accretive, would that be some a key consideration as well on the investor side?
Yes. I think DPU accretion is certainly something that investors will look at. I think apart from that, you also look at things like funding sources. How do you fund it? Do you gear up all the way, or do you take a combination of debt and equity so that you maintain your balance sheet strength? And I think certainly the REITs have been doing, both. I think this year we have seen quite a lot of issuance of perpetual securities. We've seen issuances of equity. So that has helped as well in terms of managing the balance sheet. So yeah, so I think accretion is an important factor.
Thanks, Mani. I think the important factors, right? I think maybe it's time to hear from the REITs perspective, especially United Hampshire, right? Congratulations on the recent acquisition. Maybe you can share with us, some of your asset management strategies. When do you decide to acquire a target? How do you actually decide and source for your pipeline of targets? And if you can, maybe you can take us through the new acquisition as well, Robert.
Absolutely. And we're very excited. We just announced our maiden acquisitions, 2 new grocery anchored shopping centers in Philadelphia, PA, and Richmond, Virginia. Again, along that eastern seaboard where we like to be, because you have suburban but dense locations with high buying power. And a key ingredient for us is it an infill location? In other words, is there available land around to accommodate new development? Because we don't want to buy a new shopping center one day and then have another one be built the next day and make our center obsolete. So it's very important for us to be in infill locations, what we call high barriers to entry. But growth is very important to us, obviously. As Moni knows, we're one of the smallest, if not the smallest, S-REIT with properties in Singapore. Our investors are looking for us to grow. They want to see more liquidity in our stock. So we have made a priority on growth. It's been very difficult, I would say. As I mentioned earlier, we basically launched our IPO to sync up with the pandemic. In the US, there was very little transaction activity, really in all real estate types. In the early days of the pandemic, and we were focused on working with our existing tenant base to help bridge through the pandemic. But now the situation is starting to turn the corner. There's been more transaction activity in the second quarter. Transaction activity was up 150% year over year. So we're finally looking to see some sellers in the market. We're looking at some opportunities on a daily basis. We're looking at potentially some portfolio opportunities, but growth is extremely important. But again, we got to stick to our investment criteria that really is consistent with the strategy of our REIT, which we want that number 1 or number 2 grocery anchor within a specific region. In the case of our 2 new deals, we've got one of the best Northeast regional shopping center operators in a group called ShopRite. In Richmond, we have a company called Publix, which is one of the best operators in the Southeast. Long-term leases, that whale we talked about, we're over 8 years now, which is one of the longest whales of any S-REIT. We like a good complementary of e-commerce resistant tenants or tenants that offer omni-channel. Omni-channel is very important to us, which basically means the tenants invest in technologies where they have multiple channels to get the product to the customer, be it delivery, store pickup, curbside pickup, and obviously the bricks and mortar is a big part of it. I think it's very telling. You all may have read that Amazon now has launched their own version of a off-price department store. So they completely disrupt the whole shopping center experience by e-commerce decades ago. And now all of a sudden they're realizing they need that bricks and mortar channel as one of their offerings to get their products to the consumer. So even Amazon has come full circle and realized they can't completely abandon bricks and mortar. So these are the types of things we look for: high buying power, as I mentioned, densities, consumer driven, need to be near the rooftops. And that's very critical because you've got to cut down your delivery costs to create that omni-channel initiative. And to do that, you need to cut down delivery costs. So it's very key that these locations are within the communities where, as I mentioned earlier, where people live, work, and play. So very focused on acquisitions, just announced our first and hope to announce many more over the next 12 months as our acquisition program continues.
Thanks, Robert. I think I'm quite aware of time as well, but I think let's hear from Cecilia. So I think interesting to hear from you on Sasseur's acquisition strategy as well, especially I think not just acquisition, but asset management, right? Because I think asset enhancement is also a key strategy for REITs. So if you can share a little bit more on that, and then I think after that we can proceed to answer some Q&A. I see some of that coming in. Yeah, Cecilia, thank you.
Yeah, I think while acquisition is always a key focus, but I think we need to also understand the REIT actually has two prongs approach, two growth strategies fundamentally. One is organic growth and one is, of course, inorganic growth. And I think whether you like it or not, I think the organic growth has to be the bread and butter of a REIT in terms of you making sure your underlying assets are very resilient. Now, I get this question a lot about Sasseur REIT's acquisition strategy that since listed for 3.5 years, why is it our portfolio still remains at 4? I think just to put things in perspective, I think we cannot look at the REIT by the number of properties it owns. I think it has to be also looking at the quality and also the size. The 4 properties on our books, they are worth 1.6 billion Singapore dollars. So by no measure is small. So you appreciate that this particular retail asset class that we have, they are very chunky to start with, right? So as Mani has also outlined, actually there are a lot of considerations that goes into an acquisition. So, but just to also put in perspective, actually when we listed in 2018, that time the ROFO assets, they were actually very young. The ROFO assets only commenced operations in 2017. So, as with all asset classes, they go through a sort of a growth path to maturity. So I think if Sasseur REIT were to sort of acquire some of the ROFO assets a bit too early on, I think they're going to encounter a situation, maybe those assets are not mature enough to be able to present the stable quality that the REIT would command. But so, I think with the passage of time and with also our sponsor gathering more pipeline, I think that's preparing the REIT for future proving when we actually activate our growth. So, I just came on board in August, so I'm a very new CEO. So, this is clearly a very key focus for me in terms of driving the REIT growth strategies, not just acquisition, but continuing to maintain a very strong AEI profile. So you can see that since I came on board, we have started delivering some AEI on our Bishan Mall, because the Bishan Mall we face sort of low occupancy. So we have embarked on a 2 million AEI program, and that's coming along very nicely. So hopefully in the next results, we can give you a bit more color on how we have progressed with that. So overall, I think we continue to stay focused. It is important to understand the retail assets are actually, especially the outlet malls that we have, the ROFO assets that we have, they are very huge. Just to give a scale, size of scale, like there are 2 ROFO assets, the Xi'an and Guiyang. The Xi'an GFA is 1.4 million square feet, and the Guiyang GFA is close to 2 million square feet. So, so these are not small assets that, I can just, in the span of time, I really need to plan this carefully, because the balance sheet, okay. The good thing is, just now I saw the slide in Mani's slide, is that we are the lowest geared, right? So the lowest geared, you can see that is, we have the highest opportunity to make use of our debt headroom to make very smart acquisition. And definitely, we are very focused on trying to deliver at least one of the ROFO assets, hopefully in the next 12 months, like what Robert said, in the next 12 months, he hoped to deliver another acquisition. So, I'm glad we're going to have each other as partners in this journey to make the acquisition, yes.
Thanks. I'm looking forward, 12 months, we shall see. Looking forward to all the new acquisition announcements down the road. I think we are close to 8 o'clock. I saw some questions came in, but I think, Cecilia, you've answered some of them already, especially with the, the focus on the strategy going forward and the acquisition portion. So I think in terms of questions, we are almost done. So maybe if we can just leave one last question for the audience, a nice summary from maybe the two REITs, right? What would a short summary, one sentence, two sentences, what is a key value proposition you can leave the audience with today? A nice, round up. And I think, Mani, if you have a, conclusion, just a outlook statement for the audience, that would be good as well. Yeah. Cecilia, would you like to go first?
Sure. I think Sasseur REIT, we pride ourselves as we are in a very unique space with great opportunity. As I mentioned, we are in a sunrise industry. As it is, our sponsor, they have just opened another new outlet. So we are sort of on a growth path. So watch out for us. As I said, our business model has proven very resilient in the worst time like COVID. We continue to deliver sustainable growth in DPU, and obviously going forward, we continue to be able to deliver that sustainable growth also with the increase in NAV through our AEI and also acquisition strategy.
Thank you, Cecilia. Robert?
Hampshire United is all about resiliency, stable income with NOI growth over time. It's that balance of a long-term whale with fixed increases in these long-term leases that give the investors stable yet increasing returns over time. And really the core reason for that, we offer essential goods and services that the consumer needs every day of his life to sustain himself. Sustainable, essential tenants, long-term leases, whale, income security. That is our value proposition.
Sorry, I didn't realize I was on mute. Thank you, Robert. And last but not least, Mani, would you like to have a short sentence?
We remain positive on REITs. We would advocate investors to accumulate into any weakness.
Thank you, all of you. I think we had an interesting and insightful session today. Very appreciative of the colors and updates that you've provided on the REITs sector. And I think for our participants who joined us this evening, thank you so much. Thanks for joining us, and I hope you've enjoyed the session. So if you allow me to just share my screen one more time. Let me see, just share my screen one more time. So if my screen is shared, I wanted to highlight that there is a replay available via this QR code. So you'll be able to find the others driven campaign sessions in the past by this link as well. So thank you once again, and have a good evening ahead. Of course, to Robert, have a good day ahead.
Thank you. Thanks for having me,
everyone.
Thank you, everyone. Thank you, CIMB and SGX for this session. Thank you.
Thank you, everyone. Have a good
Bye.
evening.